In the spring of 2023, Berkshire Hathaway's quarterly filling showed something that confused most of Wall Street. Warren Buffett was sitting on $130 billion in treasury bills, short-term government paper, the most boring instrument in finance. The financial press called it timidity. They said he'd lost his edge. They were wrong about what he was doing. He was loading the gun. Here are the 6 asset classes they loaded it with, and historical evidence that proves why each one works. Before the dot-com crash, before 2008, before COVID, the same pattern appeared in the filings of the wealthiest institutional investors in the world. 18 to 24 months before the crash, the same 6 assets started quietly accumulating in their books. Not after, not during, before. The mainstream financial narrative tells everyone the same thing about economic collapse. Crashes are unpredictable. Diversify, stay invested, ride it out. That advice isn't wrong. It's just designed for one group of people. The other group, the one whose SEC filings and private wealth reports tell a completely different story about which assets before a crash actually matter, has been running a different playbook for over a century. Here's what that playbook looks like. Let's go back to Buffett, because the $130 billion in T-bills isn't the interesting part. The interesting part is what happened next. When Silicon Valley Bank collapsed in March 2023, and Signature Bank followed within 48 hours, Berkshire didn't panic. It wasn't caught off guard. It was waiting. This is the first asset, short duration cash. The instrument that earns almost nothing in good times and gives you everything in a crash. A crash requires sellers. Sellers require buyers. Buyers require cash. When markets are falling, the person with cash isn't watching their wealth disappear. They're watching prices fall on assets they want to buy. And the lower everything goes, the more powerful their position becomes. Cash isn't the investment. Cash is what turns every other asset into an opportunity at exactly the moment when everyone else is being forced to sell. That's the most powerful position in a crash. In October 2008, as markets were collapsing, Howard Marks in Oaktree Capital was telling his clients to buy the bonds of companies heading toward bankruptcy. Bonds trading at 15, 20 cents on the dollar, the instruments every retail investor was fleeing. When a company goes bankrupt, shareholders get wiped out entirely. But the people who held the company's bonds move to the front of the queue. The court converts their debt into new equity and they reorganized business. Buying those bonds at 15 cents on the dollar wasn't a bet on a failing company. It was a legal mechanism for taking ownership of real assets at a fraction of their value. In April 2009, General Growth Properties, the second largest shopping mall operator in the United States, filed for bankruptcy. Brookfield Asset Management accumulated its distressed debt. When General Growth emerged from bankruptcy in November 2010, Brookfield held a controlling stake in over 200 shopping malls across America. Cost of entry, pennies on the dollar. Distressed debt is a legal door into the ownership of real assets at prices that only exist because the market is panicking and nobody else is willing to walk through. In 2023, USDA filings confirmed that Bill Gates had become the largest private owner of farmland in the United States, 270,000 acres across 18 states. Mainstream media treated it as eccentric. The financial logic is ancient. After the Black Death, landowners with liquidity bought abandoned farms for fractions of their value. During Weimar's hyperinflation, industrialists purchased farmland from families who could no longer service their mortgages. In Rome and Italy, the senatorial class accumulated land every time a debt crisis pushed small farmers into default. Different centuries, same mechanism, same asset. During Venezuela's currency crisis, farmland producing export crops, coffee, cacao, fruit sold in US dollars, held its value completely. Urban commercial property, denominated in bolivars, became worthless. One was anchored to global demand that transcended the failing currency. The other was anchored to the currency itself. Between 2000 and 2020, prime US farmland appreciated over 500%. It didn't fall during the dot-com crash. It didn't fall during 2008. During COVID, when commercial real estate lost 40%, farmland gained 7%. The floor built into land that feeds people has never once been repealed. One thing worth knowing before we move forward, of the 6 assets in this video, which ones are you already holding? The answer, across the people watching this, will be more interesting than most of them expect. Leave it in the comments. 3 down, 3 left. The next 3 are the ones that almost never appear in any public conversation about wealth preservation, including one that almost never appears anywhere. In November 2009, right at the bottom of the financial crisis, Warren Buffett made the single largest acquisition of his career. He bought Burlington Northern Santa Fe, one of the largest freight railroad operators in North America, for $44 billion. The financial press called it a bet on America, a patriotic gesture. It was something more specific than that. Tall roads, water utilities, ports, pipelines. People pay water bills in a depression. Trucks use toll roads in a recession. The demand is not just inelastic. In many cases, it is legally mandated. Nobody builds a competitor. The regulatory barriers, the land rights, the capital requirements make these assets structurally irreplaceable. Norway's Sovereign Wealth Fund and Singapore's GIC have both publicly documented their practice of increasing infrastructure allocations 12 to 18 months before periods of financial stress. This isn't sentiment. This is a forensic institutional response to a known pattern. You use infrastructure every day. You just don't think of it as a financial instrument. The toll road exists. The water main exists. And the cash flows from those assets have continued through every recession, every financial crisis, every currency dislocation in modern history. Infrastructure is the asset hiding in plain sight. You interact with it every day, and have never once thought of it as something the wealthy quietly accumulate before a crash. That gap between what's visible and what's understood is precisely where the opportunity lives. The next one will challenge something most people believe about what actually holds value during a crisis. Walk into Sotheby's in New York in the months before a major market crash. Not the public auction rooms, the private treaty department, accessible only by appointment, by referral, by relationship. Private data from the major auction houses shows a pattern that has held for 50 years. In the 18 to 24 months before every major financial dislocation, private art sales through these channels spiked dramatically, quietly, off the index. When the S&P 500 lost 57% of its value between 2008 and 2009, the top segment of the art market fell approximately 4%. 4% against 57. The Knight Frank Luxury Investment Index tracked blue-chip art through that same period and confirmed the finding. Top-tier works held value while virtually every other financial asset was collapsing. The reason is structural, not aesthetic. A Gerhard Richter painting cannot be manufactured by a central bank. Its supply is permanently fixed. Richter is no longer producing, and its price moves independently of bond yields, equity indices, or currency values. It doesn't correlate. That's the entire point. Fine art at this level isn't a passion. It's a pattern recognition with a multi-generational time horizon, wearing passion as its disguise. The opacity of the private treaty market isn't a bug. For the people using it, the opacity is the entire point. The first 5 assets in this list protect wealth during a crash. The 6th one builds it. In the mid-1970s, as stagflation was grinding through the American economy, Wayne Huizenga was buying garbage trucks, acquiring small regional waste management companies from owners who were struggling, buying their routes, their contracts, their equipment at distressed prices. He wasn't doing it despite the recession. He was doing it because of it. Garbage trucks drive the same route whether the economy is growing at 4% or contracting at 4%. People generate waste in a recession. The demand doesn't move with the economic cycle. During Argentina's 2001 collapse, the concessionaires running Buenos Aires' water distribution network faced the same collapsing currency as everyone else. Their service contracts were structured to convert local peso volumes into dollar-denominated revenue. The currency failed. The pipes didn't. Their service didn't stop. Their income didn't either. Between 2009 and 2012, institutional private equity accelerated its acquisition of essential service businesses by over 40%. Funeral homes, self-storage, water treatment, medical waste. Their revenues held. Their competitors went under. The acquirer brought routes at liquidation prices and held the monopoly while the economy recovered. These businesses were unglamorous in the good times, undervalued in the boom, dirt cheap in the bust, while their cash flows never stopped. Boring in good times means undervalued in good times. Undervalued in good times means cheap in a crash. And cheap in a crash, with stable cash flows and no competition, is where the highest returns in private equity have consistently come from. So, here's what a century of private wealth data actually shows. Short duration cash, distressed debt, productive agricultural land, infrastructure, blue chip fine art, essential service businesses. 6 assets. 18 to 24 months before every major crash in modern history, the same 6 categories started quietly accumulating on the books of the wealthiest institutional investors in the world. Most people are taught that a financial crash is a disaster that happens to everyone equally. The data tells a different story. Every major crash has also been a transfer, from the people who were in position to the people who were, from the panicked to the patient, from the people liquidating to the people buying. Wealthy don't treat crashes as disasters to survive. They treat them as scheduled events to prepare for. I'm not saying that to be sensational. Nobody knows the timing of the next crash or what triggers it. What I am saying is that the people who came out of downturns wealthier than they went in were not smarter than everyone else. They prepared, quietly, in advance, with specific assets, before the exit closed. If you haven't watched the companion to this video yet, the 6 assets that don't just survive a crash, but that have survived every collapse in recorded history, from Weimar to Zimbabwe, that one is already up. The SEC filings are public. The historical data exists. The pattern has been visible for a century. The only question left is a personal one. If the next crash has already started casting its shadow forward into the present, where do you want to be standing when it arrives? Subscribe. Every week on this channel, we go through the actual historical record, what the wealthy did, when they did it, and what the rest of us can learn from the pattern. Next, the assets that go to zero in a real collapse, including 2 that almost every financial advisor will tell you are the safest things you can own. History has the answers. I'll show you where to look.